We let the genie out of the bottle.
Those aren't the words of a scientist or a futurist. They're from Warren Buffett, the greatest investor in history. And he wasn't talking about the past. He was talking about our present, about artificial intelligence. For the last few years, AI has promised to revolutionize everything. A new industrial revolution, a market that some claim could reach $7 trillion. But as the world dives headfirst into this digital gold rush, the Oracle of Omaha is sounding an alarm, a surprisingly pessimistic one. He's compared AI to the invention of the atomic bomb. Now, for a man of Buffett's generation, a generation that grew up under the shadow of the Cold War and the existential threat of nuclear annihilation, this is not a casual comparison. He understands what it means for humanity to create something with consequences so vast, they are simply unknowable. He sees AI not just as a tool for efficiency, but as an irreversible force with an awesome potential for good and an awesome potential for harm. This brings us to today's central question. Why is the man who built a fortune of over $100 billion by being optimistic about America so wary of our generation's greatest technological revolution? And more importantly, while he warns us of the dangers, what is he doing with his money behind the scenes? The answer may surprise you. This is a financial education channel. Analysis is based on the public statements, shareholder letters, and SEC filings of Berkshire Hathaway and Warren Buffett. Educational content only, not investment advice. To understand Buffett's strategy, we first need to understand his fears. And they run deep. At his most recent shareholder meeting, Buffett didn't focus on the profits AI could generate. He focused on the new growth industry it will create. The scamming industry. He said, and I quote, "If I was interested in investing in scamming, it's going to be the growth industry of all time. And it's enabled, in a way, by AI. This isn't just an abstract concern. Let's make it real." Imagine a CFO at a major corporation. He gets an urgent call from his CEO, who is traveling. The voice is perfect, the intonation, the slight impatience. Everything matches. The CEO says a secret, time-sensitive acquisition needs a wire transfer of $25 million immediately, and that an email with instructions is on the way. The pressure is immense. The CFO acts, but there was no acquisition. There was no CEO on the phone. It was an AI clone. That's not a movie plot. It's a real threat that keeps corporate leaders up at night. For Buffett, this is no longer science fiction. It's the next frontier for criminals. And he wasn't alone in his caution. His late partner, the legendary Charlie Munger, was even more direct. To him, AI was a topic with, in his words, more hype than it deserves. But Munger's skepticism went deeper than a simple quote. He spent his life warning about what he called Lollapalooza effects, when multiple psychological biases and market forces combine to create an explosive, often irrational outcome. For Munger, AI looked like a textbook Lollapalooza catalyst. You have the fear of missing out, the allure of a revolutionary narrative, and a flood of capital all converging at once. He saw it as a natural evolution of automation, not some magical force that justifies the market valuations we see today. And what are those valuations? This is where we get to that famous figure, the $7 trillion AI bubble. You've probably seen the headline. $7 trillion AI bubble? Sounds like the size of a bubble just waiting to pop, right? But the truth, as always, is more complex. Our research shows this number doesn't refer to the value of AI stocks. It comes from a McKinsey report estimating the cost to build the infrastructure, the data centers, the servers, the cooling systems needed to support AI by 2030. Think of it this way. It's not the value of all the cars on the road, but the cost to build all the roads, bridges, and tunnels those cars will need to use. It's an investment in foundations. And that distinction is the key to understanding what Buffett did next. While Buffett publicly warns about the dangers of the genie leaving the bottle, his company, Berkshire Hathaway, was making moves in the shadows. To find them, you don't look at flashy TV interviews. You have to go to Wall Street's confessional, the dry regulatory documents filed with the SEC, specifically a form called the 13F. This is where big investors are forced, by law, to disclose their holdings. It's where the real story is told in black and white. And as analysts parsed Berkshire's latest filing, they found something fascinating. In the quiet of the markets, Berkshire had made a calculated move, an investment of over $4 billion. And what was the target? A risky AI startup? A biotech firm with futuristic promises? No, Berkshire Hathaway invested in Alphabet, Google's parent company. At first glance, it looks like a contradiction. But look closer, and you see the classic Buffett pattern. This isn't the first time he's bet on the railroads of an economy. He did it by buying a literal railroad, Burlington Northern Santa Fe, recognizing it as the circulatory system of American commerce. He did it with Berkshire Hathaway Energy, understanding that everything runs on power. And now, in the 21st century, he's doing it again, investing in the digital railroads of our time. Because Alphabet isn't just a search engine. It's the company selling the picks and shovels during the AI gold rush. It owns Google Cloud, one of the 3 largest cloud infrastructures on the planet. It owns Google AI and DeepMind, 2 of the most advanced research labs in the world. Investing in Alphabet isn't betting on which AI application will win. It's a bet on the racetrack itself. It's a move that has all the hallmarks of one of Buffett's 2 portfolio managers, Todd Combs or Ted Weschler. They're the younger investment lieutenants at Berkshire, more naturally fluent in the language of tech. It's highly likely one of them initiated this investment, but it would have never gotten the green light if it didn't align perfectly with the master's core philosophy: value investing. Buffett isn't buying the hype. He never does. He's buying a business with what he calls an economic moat, an almost insurmountable competitive advantage. Alphabet's moat is its global infrastructure, its billions of users, and its R&D firepower. For Alphabet, AI isn't the end product. It's a powerful tool that makes all its other products, from search to advertising, from cloud to Android, even more dominant. This brings us to the fundamental difference between speculating and investing. Speculating is buying a stock you hope will go up because of a popular story. Investing is buying a piece of a wonderful business you understand. The speculative AI stock has no profits, just a grand vision. Its price is based on hope. Alphabet has a massive, gushing river of free cash flow. Its price is based on earnings. It's the difference between buying a lottery ticket and owning a piece of the lottery itself. The apparent contradiction dissolves. Buffett's public warning is for the everyday investor, the person who might get seduced by promises of quick profits in volatile, unknown AI stocks. It's a fatherly warning against speculation. Berkshire's private investment, on the other hand, is a clinical lesson in investing. It's the purchase of a high-quality, durable business at a reasonable price, which is positioned to benefit from the growth of a fundamental technology, no matter who wins or loses on the application layer. The lesson is clear. Be skeptical of the euphoria, but don't ignore the technology. Invest in solid, lasting companies that use innovation as a tool, not as a lottery ticket. So in the end, Warren Buffett's AI strategy isn't a contradiction, but a masterclass on the difference between price and value. He teaches us to separate the noise from the signal. The noise is the bubble hype, the get-rich-quick promises. The signal is the quiet investment in indispensable infrastructure. Buffett's move into Alphabet gives us a crucial clue about where the real value is being built in this new era. But it also, indirectly, points to where the biggest risks are concentrated. If Alphabet is selling the picks and shovels, there is one company that is the gold mine itself, the beating heart of the AI revolution. a company whose market value has exploded in a way that defies gravity. In our next video, we're going to investigate that company. We will dive into the epicenter of the AI earthquake and ask the question that should be on every investor's mind today. Is Nvidia the most dangerous stock in the world? You won't want to miss it. Subscribe and turn on notifications.